Alright, picture this. You're scrolling through your phone, eyeing that sleek Robinhood debit card. It promises easy spending, seamless access to your investments, and maybe even a little cashback. But then, a nagging question pops into your head. If something goes sideways, are my funds actually safe? Are they FDIC insured like my good old bank account? Seriously, think about it. We pour our hard-earned money into these platforms, trusting them to safeguard our financial well-being. But in today's digital age, with all the volatility and the constant barrage of news about financial instability, that question becomes more than just a passing thought. It becomes a critical concern. We're talking about your money. The money you saved, the money you plan to use for rent, groceries, maybe even that dream vacation you've been putting off. You wouldn't leave it lying around in a shoebox, would you? So, why would you be any less careful about where you park it in the digital realm? Now, the answer to whether Robinhood spending accounts are FDIC insured isn't a simple yes or no. It's a bit more nuanced, and that's precisely what we're going to unpack today. Because understanding the intricacies of FDIC insurance and how it applies to fintech platforms like Robinhood is absolutely crucial for protecting your financial assets. Let's break it down. First, what exactly is FDIC insurance? The Federal Deposit Insurance Corporation, or FDIC, is an independent agency of the United States government that protects depositors' money in the event of a bank failure. It insures deposits up to $250,000 per depositor, per insured bank, for each account ownership category. This means that if your bank goes under, the FDIC will step in and reimburse you for your insured deposits, up to that limit. This insurance provides a critical safety net, fostering trust and stability in the banking system. It's the reason why we generally feel safe keeping our money in traditional banks. Now, here's where things get interesting with Robinhood. Robinhood, at its core, is a brokerage platform. It allows users to buy and sell stocks, options, and cryptocurrencies. But they've also expanded into offering cash management features, including spending accounts and debit cards. Here's the key point: Robinhood itself is not a bank. Therefore, Robinhood itself is not FDIC insured. However, Robinhood partners with a network of banks to offer its cash management features. And it's through these partnerships that FDIC insurance comes into play. When you deposit money into your Robinhood spending account, those funds are swept into accounts at these partner banks. This sweep mechanism is how Robinhood provides FDIC insurance. Your funds are essentially held at one or more FDIC-insured banks, and you, as the depositor, are eligible for FDIC protection up to the standard limits. But there are a few important caveats to consider. Firstly, the number of partner banks Robinhood works with can vary. This means that your funds might be spread across multiple banks to maximize your FDIC coverage. However, it also means that you need to be aware of the total amount you have deposited across all these banks. Remember, the $250,000 limit applies per depositor, per insured bank, per ownership category. If you have more than that amount spread across the banks Robinhood uses, the excess amount won't be insured. Secondly, it's crucial to understand the difference between your brokerage account and your spending account. Your brokerage account, where you hold your stocks and other investments, is not FDIC insured. It's protected by the Securities Investor Protection Corporation, or SIPC. SIPC insurance protects your securities in the event that a brokerage firm fails, but it doesn't protect against market losses. So, while your cash in the spending account is potentially FDIC insured, your investments are covered by a different type of protection. Thirdly, always double-check the fine print. Robinhood's terms and conditions, as well as the terms of their partner banks, can change. It's essential to stay informed about the latest policies and procedures regarding FDIC insurance. Now, let's address some common misconceptions. Some people assume that because Robinhood is a large and well-known company, their funds are automatically safe. But size and popularity don't guarantee FDIC insurance. It's the specific structure of the account and the involvement of FDIC-insured banks that matter. Others might think that because they have a Robinhood debit card, their funds are protected like a traditional bank account. While there are similarities, the mechanisms behind FDIC insurance are different. In a traditional bank, your funds are directly deposited into an FDIC-insured institution. With Robinhood, they're swept into partner banks. Another common misconception is that all cash held within Robinhood is FDIC insured. As we've already discussed, only funds in the spending account, held at partner banks, are eligible for FDIC protection. Funds in your brokerage account are not. So, what can you do to ensure your funds are protected? Firstly, keep track of the amount you have deposited in your Robinhood spending account. Make sure it stays within the $250,000 limit per bank. Secondly, familiarize yourself with Robinhood's partner banks. You can usually find this information in their terms and conditions or by contacting their customer support. Thirdly, diversify your cash holdings. Don't put all your eggs in one basket. If you have a significant amount of cash, consider spreading it across multiple FDIC-insured institutions. Fourthly, read the fine print. Stay updated on Robinhood's policies and any changes to their partner banks or FDIC insurance coverage. Fifthly, understand the difference between FDIC and SIPC insurance. Know which types of accounts are covered by each and what those protections entail. In today's complex financial landscape, it's more important than ever to be informed and proactive about protecting your assets. Don't assume that your funds are automatically safe just because you're using a popular platform. Take the time to understand the specifics of FDIC insurance and how it applies to your accounts. Ultimately, whether you choose to use a Robinhood spending account or stick with a traditional bank account is a personal decision. There's no one-size-fits-all answer. It depends on your individual needs, risk tolerance, and financial goals. If you value the convenience and integration of Robinhood's platform and understand the nuances of FDIC insurance through their partner banks, then it might be a suitable option for you. However, if you prefer the simplicity and directness of a traditional bank account, where your funds are directly deposited into an FDIC-insured institution, then that might be a better fit. The key is to make an informed decision based on your own research and understanding. Don't rely on assumptions or hearsay. Take the time to educate yourself and protect your financial well-being. Remember, financial literacy is a superpower. It empowers you to make informed decisions and take control of your financial future. And in today's digital age, it's more important than ever. With that said, thanks for watching and until next time.